All right, let's talk about Web3. You've seen it happen, right? This massive hype, a huge launch, and then just silence. So today, we're going to dig into why so many of these supposedly promising projects just seem to disappear into thin air.
I mean, look at this number, 90%. That's staggering. An estimated 90% of all Web3 projects fail after they launch. And yeah, it's easy to point fingers at bear markets or, tough regulations, but what if the real problem is something deeper? Something that's actually built into their DNA right from the start?
Well, it turns out, when you look at hundreds of these projects, a really clear pattern starts to show up. This huge failure rate, it's not an accident. You could almost say it's a feature, not a bug. For so many of them, failure is literally baked into their architecture from day one.
Okay, I know what you're thinking. That sounds a little conspiratorial, right? But this isn't really about some grand secret scheme. It's more like a repeatable blueprint for failure. So the big question is, how do so many totally different projects end up on the exact same road to collapse? Let's get into it. So let's start at the very beginning. We can call this the illusion phase. And this is where the whole foundation for failure gets laid, way before a single line of code is ever even written. You know this playbook. I bet you've seen it a million times. First, you get this super slick cinematic teaser. Then bam, a polished white paper drops, just packed with jargon and all the right buzzwords. And then, suddenly your social media feed is just flooded with all these influencer threads, all pushing the exact same revolutionary story. The goal here is super simple. Create as much hype as humanly possible before anyone has a chance to ask, hey, where's the actual product? And what this hype machine does is create two very, very different groups of people. On one side, you've got the insiders, right? The team, the VCs. They get the lion's share of the token supply for pennies on the dollar. And on the other side, that's the retail crowd. They're the ones who buy the story, they're lured in by things like airdrops, and, well, they end up being the exit liquidity for those early insiders. And this is where a huge misunderstanding about community comes in. See, airdrops and other financial rewards, they don't build a community of true believers. As the saying goes, they just attract temporary capital. The second those incentives dry up, poof, those so-called users are gone. Okay, so the hype is built, you've got this initial community of temporary capital. What happens next? What are the real structural problems that lead to the collapse we see so often? Well, let's break down the 5 fatal flaws that are pretty much always there. And you'll see these 5 pop up time and time again. It starts with hype over the actual product. Then you've got insider-heavy tokenomics. There's no sustainable revenue, just a dependency on liquidity mining. And finally, it all crumbles with weak roadmap execution. Let's start with flaw number 1, hype over product. This is the big one. It's when the marketing budget is just way, way bigger than the development budget. The launch gets rushed out the door, they just assume they have product market fit instead of proving it, and the whole thing relies on the narrative because there's just no real utility there to back it all up. Next up, flaw number 2, and it's all in the tokenomics. Look at this chart. When insiders control this much of the supply, especially with short vesting periods, you're basically creating a ticking time bomb. Because the second those tokens unlock, a massive wave of sell pressure is ready to just flood the market, and that can absolutely crush the price for everybody else. All right, flaw number 3 is a pretty basic misunderstanding of economics. A lot of these projects keep themselves afloat by just printing new tokens. They use them to reward users for things like providing liquidity. But here's the thing you have to understand. These token emissions are a subsidy. It's not revenue. You're just paying people by inflating the token supply, not from money the protocol is actually earning. And this quote just nails it perfectly. That's not growth. That's rented attention. I mean, think about it. If people are only using your protocol because you're paying them with these inflationary tokens, you haven't actually grown anything. You've just rented their attention for a little while. And trust me, that lease is going to run out. So those first 3 flaws, they naturally lead to these next 2. Flaw number 4 is that the project becomes totally dependent on liquidity mining. The TVL, or total value locked, looks great while the rewards are high. But the moment those rewards start to drop, the TVL just collapses. And that leads directly to flaw number 5, weak roadmap execution. With no momentum, a dying token price, and a shrinking treasury, all that development just stops.
And that ambitious roadmap, it becomes nothing more than an empty promise. And this is where it all comes together. We can now see how all these flaws combine and feed into each other to trigger the final catastrophic collapse. It's a negative feedback loop that has a name, the liquidity death spiral.
Okay, so here's how it plays out step by step. First, those insider tokens start to unlock, and of course, they begin selling to take profits. This new supply hitting the market weakens the price. That, in turn, causes retail to panic sell. As the price tanks and confidence evaporates, the TVL plummets. Then the engagement disappears. The Discord goes quiet. The project's own treasury, which is usually held in its own token, is now worth a fraction of what it was. And that's the final nail in the coffin. Development halts, it's a total cascade effect, and it happens fast.
But here's the good news. Even though this pattern is super predictable, it's not inevitable. I mean, some projects do make it. They survive, and even thrive. So how do they do it? How do they avoid this fate? What's the antidote to this architecture of failure?
Well, pretty simply, the projects that last do the exact opposite of everything we just talked about. They are absolutely obsessed with finding real product-market fit. They build a business model where actual revenue from people using the thing is greater than the tokens they're printing. They're disciplined with their treasury. And this is key. Their token is treated like a useful tool for the community, not just an exit strategy for the team.
I mean, look at this side by side. The contrast couldn't be more stark, right? It all comes down to these fundamental questions. Is the focus on hype, or is it on the product? Is the revenue just token emissions, or is it from real usage and fees? Is the token just a way for insiders to cash out, or is it a tool for governance? And is the community just a bunch of mercenaries, or is it made up of organic believers? These are the questions that really separate the projects that are designed to fail from the ones that are actually built to last.
So as we look to the future, this is really the core question for the entire Web3 space. Is the next wave just going to be a repeat of these same old flawed hype cycles? Or is it going to be built on sustainable models that actually prioritize substance over narrative? The truth is, the architecture for what's next is being designed as we speak. And understanding these patterns of failure is the absolute first step to making sure it gets built on solid ground this time.
Subscribe and visit Web3 Newswire for visibility and credibility of your Web3 projects.